US markets on a turn the final weeks of the year. Year to date, the Dow's up 13%. The S&P is about 25% higher. The Nasdaq's up 45%, partly because of AI. Global markets a little different. FTSE's only marginally up. France 15%. I'll take that, with good strong gains in the Nikkei, and the Hong Kong Hang Seng, as you can see, fell sharply. Stephanie Roth is the chief economist at Wolfe Research. Why doesn't my portfolio look like that?
Well, it's been a very interesting year for markets, in part because it was largely led by a couple of the bigger names.
Right.
But when we're looking for next year, because the economy is likely to actually experience the softish landing, we might see a broadening out of the market, which should help your portfolio.
Good, thank you. Now, this idea of the soft landing, I was a skeptic, a cynic, whatever you want. I didn't think it was going to happen. I thought there'd be a full throttle recession, etc., etc. Are we out the woods in the US yet?
Well, certainly it was you and everybody else heading into this year. Most economists were calling for a recession. I think we're now close to out of the woods. Of course, there's always the chance that the economy slips into recession, and we are still in the late part of the economic cycle. But I think we're getting close to out of the woods, and recession risk is starting to return to normal. A big reason is because the Fed is now able to potentially cut interest rates for good reason. Cutting interest rates because inflation is now down to close to something looking like 2%.
So how many rate cuts? And I noticed that what you were saying in one of your notes about essentially the Fed's preferred rate is just about at target, give or take. So how many rate cuts do you think we'll see next year?
Yeah, sure. We got the core PCE data today, and now your 3-month run rate is about 2.2%, which is very close to the Fed's 2% target. My base case is that we'll get about 3 rate cuts next year, starting in Q2. And they'll probably move slowly, about once every quarter. And by the way, that forecast is a little bit different than the market. The market's expecting almost double that. They're expecting 6 rate cuts. I think in an environment where there's 6 rate cuts, that's a more dire economic outcome. So base cases look very similar to what the Fed thinks, which is for 3 cuts next year.
So by the time we get to the end of next year, I mean, rates will be looking lower, yeah, obviously, but they'll be almost back to traditional levels. We're never going back to zero, are we? So the trough rate is going to be, what, 3.5?
I think the trough rate could be somewhere between 2.75 and 3, which, isn't that bad. And that could be consistent with a 10-year treasury of about 3%. And that's not so bad. That's going to feel a lot better than, where we've been for the past couple of years.
How aware, this is completely out of left field though, how aware will the Fed be or conscious that AI, like the internet before, is going to create such productivity gains that we cannot even fathom, let alone quantify, that they're going to need to be cautious, keep a tight rein on the horse, because the horse now wants to gallop?
I mean, I think that's fair, but at the same time, it's going to probably take quite a bit of time for that to actually play out. And by the way, when we have a strong productivity backdrop, that means there's downward pressure on inflation. So that's a very different kind of backdrop, and one that they're going to be a lot less concerned about. And they'll keep an eye on it. We'll see if potential growth really does start to pick up. But I think we're still a ways away from that.
Right, Stephanie, I'll be back to talk to you next year for this broadening out of the gains which you have promised me. I'm very grateful. Have a lovely holiday, whatever you may be celebrating. I wish you well over a festive season. Thank you.